Jeremy. I suppose the other aspect to all of this, slightly touched on, is credit rating management, really. And small businesses generally are immature, probably, in understanding the processes that do affect their credit rating, and don't proactively manage that process. And clearly, whether you're trying to attract grants or support from government departments like ECGD, or whether you're trying to get trade credit insurance for export markets as well as home markets, you need to make sure that the management processes related to your credit rating are sound.
I'd like to sort of echo Phil's comments to a large extent. I think it's got to be about understanding who the customer is, and clearly once you move outside of the UK, that starts to get more difficult when you've got different time zones, you've got different languages, you've got different cultures in terms of what the payment expectations might be. So I think that there's a lot that particularly small businesses need to understand when they're considering exporting. From a HSBC perspective, of course, this is one of the things that's it's key to our strategy, both as a bank and more specifically within the invoice finance business. And we have a very strong international credit control team. They actually sit on the same floor as me, so I walk around the floor and hear these multitude of different languages being spoken, which is amazing, and it's really interesting to hear that. But it reinforces to me the difficulties that we see when we're trying to collect abroad. We have people working different time patterns in order to catch people at the right time in the different countries. For one individual business to do that, it's very, very difficult.
Okay, any more questions from the audience? I think we've got one here.
Hello, I'm Rod Howell, Credit Manager of RM Curtis, which supply food products. One of the areas I'd like to know if there's any change going to be about errant directors. There's so many directors of businesses which fail businesses, walk away and start up another one. And in this current environment, there's lots and lots of more businesses like this which trade purely on moving from one place to another. And it's like an epidemic in this current environment. It's got worse from my point of view. What's happening? What do you see happening in that area to enforce more controls over errant directors?
Who would like to take that one up first? I mean, perhaps it might be good to come to Stephen first, okay, because banks obviously have seen levels of insolvencies fluctuate in the last 2 or 3 years. Yeah. Could you give us an idea of what measures are being put in place?
Cool. I mean, actually, an interesting thing on insolvencies is insolvencies have risen nothing like as much as they did in the early 90s. You know, SMEs have been fantastically flexible through the way they've kind of managed through this recession. I don't think they were as overborrowed actually as they were in the late 80s. They're kind of, it's the one bit of the economy that didn't go mad, unlike the government, consumers, and some parts of the major corporate side. You know, it is an issue, and we've seen a lot of pre-packs, haven't we? You know, in terms of those receiverships and administrations, where a business, quite rightly, has some potential future with a different financial structure. A new company is formed, you know, on usually the same day as the old company is wound down, and surprise, surprise, sometimes it's the same people involved who've kind of left creditors, taxpayer, and sometimes employees in the lurch, and kind of seem to have carried on regardless. That doesn't feel good, does it? And I think, you know, there's clearly some controls there to make sure that there is proper value being got for the creditors in that situation. We certainly look at the history and credit ratings of directors when we're lending to businesses and considering opening accounts. That doesn't mean to say we won't do business with people who've, you know, not perhaps for their own fault, had some difficulty in the past. They may have learned from that experience, but I think it's incumbent on all of us, I think, to make sure that that is you know, more widely understood, and that, you know, on an informal basis, make sure that key contacts and so on are aware of the history.
I think on top of that, really, Companies House don't enforce any issues on directors, which we'd like to see more of that from a credit manager point of view. And also that in Companies House they're receiving lots of balance sheet information. Companies are being set up with fraudulent information and they're just passing through Companies House. And then when you get to credit check them, credit managers need to be very much on their guard that they're not being, the wool's not being pulled over their eyes when they're looking at companies.
I think the only thing that I would add here is that I think there's an appreciation within government that there is a concern that pre-pack and bankruptcy has become too easy an option. And I do sense that there might be more of an appetite with the coalition government to look at whether changes are necessary. I know that there are reviews underway of the approach of the Insolvency Service, and I think they're aware of the issues, but whether actions will come is the big question.
Wanted to ask Phil, actually, the FPB's perspective on pre-packs and errant directors, because I presume your members have suffered and they've seen a new director start up a new business and they've effectively shedded the debts. What's your overall take on these kinds of instances and what you can do to help your members protect against them?
Yeah, well, it's not a new problem, is it, by any means, although I think it's becoming more common, probably as you've highlighted. I think conversely, just slightly from what Paul was saying there, I mean, there is, I sense particularly within the Conservative part of the coalition that there is this sort of desensitising of liquidation, administration, and to some extent pre-packs, following the American model that, you know, you should not be penalised for failure. But with that clearly come risks to the supply chain, and I think we've got to monitor that very, very closely. I think we've also got to take account, of course, is that generally I think business owners would be fairly ignorant of the mechanisms for entering into a pre-pack arrangement. They are clearly seeking and receiving advice from the accounting bodies. I personally would like to see more of an approach related to company voluntary arrangements prior to consideration of pre-packs, and really pre-packs being used as a mechanism of last resort if the creditors are not prepared to support a CVA. So I think there are mechanisms that can be used to alleviate some of these problems. From a membership perspective, we actually see within our membership very, very few pre-packs. In fact, some fairly detailed recent analysis that we did of our member base showed that over 70% of them actually are in a very healthy credit position. Now that might be a nuance within our membership base and may not be representative of all the business bodies or clearly all the larger small and micro business community. But it's a difficult one to answer, really. I mean, clearly, you know, people who are hurt by these things are emotionally hurt as well as financially hurt. And I just think clearly what we've got to do is try and educate more about processes that would support creditors and supply chain management as part of a survival process, rather than just immediately accounting bodies or advisors going straight for PPAC.
Okay, any more questions from the audience? Got one at the front.
Alex Cardno, Credit Today magazine. I wanted to ask the whole panel their opinion on what the impact will be of factors such as changing regulation for banks, economic factors such as a base rate increase, what impact that is going to have on levels of commercial lending, and also, Karen, what impact that will have, if any, on the utility space for SMEs.
If I could come to Kevin first for that one.
Yeah, thanks. It comes down, I guess, any lending decision comes down to understanding whether the business is viable. And certainly from a HSBC perspective, that's always been what we've tried to do. We've been consistent with our sort of lending policy and lending criteria, haven't changed them materially over the last 3 years. And it comes down to really trying to understand the business. Base rate increases will clearly have an impact because that will affect a business's ability to service its debt and to repay its debt, because it's simply going to be more expensive. So that needs to be factored into any consideration. But I think there's there's a sort of an understanding that we've had a very long period of base rates at a historically low level, and so the decisions we've been making, not just today but yesterday and for the last couple of years, have been on that basis, and we are a prudent lender, and so we're making decisions based on an assumption that base rates will go up. From a regulatory point of view, I think that's something that's more, it's very pertinent from an invoice finance perspective, because the cost of capital associated with a structured facility such as that my business can offer are less than with other unstructured forms of finance. What that means is that there should be benefits that we can both gain from that, from the point of view of the bank and from our customers, and either by way of being able to fund our customers at a higher level than we would otherwise be able to do, or by way of some sort of cost differential and preferential charges for a structured product, and in which way we both gain.
And if I could come to Stephen next.
Yeah, I mean, first of all, on that point about regulation, as I said earlier, I don't think fundamentally that capital and liquidity regulation is a huge issue per se for the SME sector, unless it got really badly out of balance, just because of the materiality of lending within a balance sheet. If, you know, certainly for Lloyds Banking Group, we'd prioritise this market kind of almost beyond any other. But where I'm slightly more thoughtful is around the kind of conduct regulation. And if you get very onerous conditions on accreditation, on requirements for notice periods, the structure of products and information that needs to be provided, which is designed for consumer lending, applied, you know, without proper adjustment to business lending, what you would begin to see, I think, is a restriction on the range of products, higher costs for customers, and in some cases there will be some players in the market that will just say, you know, it's all too much hassle to do it. So I think a proper understanding of the difference between business lending, the importance of you know, flexibility, because businesses are going to need to have the ability to change their credit facilities. It's no good saying, you know, you have a credit offer and then you have a cooling off period for a month if you need an overdraft this afternoon, you know, for instance. So I think that's bigger. In terms of interest rates, similar story really. You know, we're through the cycle lender, been prudent in the you know, boom times, and that's enabled us to carry on lending in the more difficult times. And we do look at a reasonable level of interest cover to allow for those rises in rates. This morning, I think, on the back of the Bank of England's inflation report yesterday, the expectation is that interest rates won't rise at quite as fast a level as we were thinking, even though inflation's quite high because of the slow pace of growth. So I think the latest expectations are that it might be 1.5% by, you know, late next year. So historically, interest rates are at a fantastically low level. I mean, on average, an SME is paying about half in total interest of what they were paying in 2007. So it has some way to go before that's a real constraint on a good business. But clearly there are businesses at the margins that need to be prepared to do that. And I'd hope that more businesses are beginning to look at fixed rates now to have that kind of certainty. We still see relatively few taking them. You know, that's the reality. It is a bit more expensive, but people's inclination is to kind of go for the low variable rates at the moment rather than thinking fixed.
And if I could come to Lucy next, actually, what your general thoughts are on the impact of a base rate increase?
I think if we go back somewhat, that what the credit crunch did was, for the first time, made it starkly clear to businesses that their supplier of credit, their bank, largely, not exclusively, but their bank, was just that, a supplier of a resource to their business, and that supplier was subject to risk in the same way that every other supplier was. And we lived in a world before